Cost. Defendant's refusal to engage with ADR result in award of indemnity cost to claimant. In a decision which should emphasize the need to comply with direction ordering parties to consider alternative dispute resolution, a claimant was awarded indemnity costs as a result of the defendant failing to engage ADR. The court awarded indemnity costs commencing from a date 1 month after a direction ordering the parties to consider ADR. The claimant had attempted to engage the defendant, who not only refused to engage with ADR but also didn't respond to the claimant's Part 36 offers. This conduct took the case out of ordinary, justifying the indemnity cost order. The claimant was successful in proving vicarious liability on the part of the defendant after a volunteer football coach sexually abused the claimant on a trip to New Zealand when he was a minor in 1987. The claimant was awarded £17,000 in damages, and a second hearing then took place. The parties were unable to agree whether costs should be awarded on the standard or indemnity basis, the amount of an interim payment on account of costs, and whether there should be permission to appeal. Indemnity costs. The claimant argued indemnity costs were appropriate. The claimant had made a Part 36 over a £10,000 in December 2019 and was awarded in exchange of his sum at trial. CPR 36 provides that the court must, unless it considers it unjust to do so, order that the claimant is entitled to costs, including any revocable pre-action costs, on the indemnity basis from the date on which the relevant period expired. The defendant argued an order for indemnity costs would be unjust as proportionality was an important issue. The claimant cost budget had been based on a valuation of the claim far exceeding the damage award being valued by between £50,000 and £100,000 at that time. Mr. Justice Griffith was not persuaded by the defendant's argument and said it would not be unjust to make an order for indemnity costs. Indemnity costs usually result when a defendant fails to beat a claimant's Part 36 over, and on no view will the claimant recover, even on an indemnity basis, more than the cost he has actually incurred. He therefore ordered that the defendant pay the claimant costs on the indemnity basis from expiry of the claimant £10,000 Part 36 over at the very least. ADR. The claimant also submitted that an order for indemnity costs should be made because the defendant failed to engage in alternative dispute resolution (ADR). In October 2019, the claimant wrote to the defendant with an invitation to enter into settlement negotiation, to which the defendant responded that it continues to believe that it has a strong defense and no purpose would be served by any form of ADR. The defendant also failed to respond to 3 Part 36 offers from the claimant. Mr. Justice Griffith found that the defendant's reasons for refusing to engage in mediation were inadequate. The defendant didn't have a strong defense. It lost the case, and in any event, no defense, however strong, by itself justifies a failure to engage in any kind of alternative dispute resolution. The defendant conduct in refusing to engage with ADR and to respond to the claimant Part 36 overtook the case out of the norm and justified an indemnity cost order. An order for indemnity costs for the totality of the claim would not be fair and appropriate. However, the court ordered that indemnity costs be awarded from 1 December 2018, 1 month after the direction ordering the parties at all stages to consider settling this litigation by any means of alternative dispute resolution. Interim payment on account of costs. Mr. Justice Griffith ordered an interim payment of £200,000 on account of costs. Permission to appeal. Permission for the defendant to appeal the outcome of the claim was refused on the basis that none of the grounds were considered to have a real prospect of success as required by CPR 52. What can we learn? This decision should stand as a warning to defendant and their representative. When a direction order states that the parties must consider ADR, it is not sufficient for a defendant to rely upon the strength of its defense as mean of outright refusal. Thank you. Voluntary life insurance. Voluntary life insurance is a financial protection plan that provides a cash benefit to a beneficiary upon the death of the insured. It's an optional benefit offered by employers. The employee pays a monthly premium in exchange for the insurer's guarantee of payment upon the insured death. Employer sponsorship generally makes premiums for voluntary life insurance policies less expensive than individual life insurance policies sold in the retail market. Many insurers provide voluntary life insurance plans with additional benefits and riders. For example, a plan might feature the option to purchase insurance above the guaranteed issue amount. Depending on the amount of increase, the policyholders may be required to submit proof that they meet minimum health standard. Another is coverage probability, which is the ability of a policyholder to continue the life policy upon termination of employment. Each employer has guidelines for porting a policy. However, it is typically between 30 and 60 days after termination, and it requires the completion of paperwork. A third option is the ability to accelerate benefits, whereby the death benefit is paid during the life of the insured if they are declared terminally ill. There is also the option to purchase life insurance for spouses, domestic partners, and dependents, as defined by the insurance company. Lastly, an immeasurable benefit offered by most employers is the option to deduct premiums from salary. Payroll deductions are convenient for the employee and allow for the effortless and timely payment of premiums. Special consideration. In addition to these benefits, some insurers provide optional riders, such as waiver of premium and accidental death and dismemberment riders. Riders are most often executed at issue and for an additional fee. Voluntary life insurance is often available to employees immediately or soon after hire. For employees who opt out, coverage may next be available during open enrollment or after a qualifying life event, such as a marriage, the birth or adoption of a child, or divorce. Selecting the right type of voluntary life insurance requires examining current and anticipated needs and is dependent on each person's circumstance and goals. Additionally, it's also worth comparing an employer's offering with plans of other firms to ensure it's among the best life insurance policies currently available. There are two basic types of voluntary life insurance: voluntary whole life and voluntary term life. Types of voluntary life insurance. There are two types of voluntary life insurance policies provided by employers: voluntary whole life and voluntary term life. The latter is also known as group term life insurance. Face amounts may be in multiples of an employee's salary or stated values, such as $20,000 and etc. Voluntary whole life insurance. Voluntary whole life protects the entire life of the insured. If whole life coverage is elected for a spouse or dependent, the policy protects that person's entire life as well. Typically, amounts for spouses and dependents are less than amounts available for employees. Just as with permanent whole life policies, cash value accumulate according to the underlying investment. Some policies only apply a fixed rate of interest to the cash value, whereas others allow for variable investing in equity funds. Voluntary term life insurance. Voluntary term life insurance is a policy that offers protection for a limited period, such as 5, 10, or 20 years. Building cash value and variable investing are not characteristic of voluntary term insurance. As a result, premiums are less expensive than their whole life equivalents. Premiums are level during the policy term but can increase upon renewal. Voluntary life is often paid with pre-tax dollars. If it is paid with after-tax dollars, it may be tax deductible. Example of voluntary term life insurance as a supplement. Some participants choose voluntary term life as a supplement to their whole life insurance. For example, Jordan is married with children and has a $50,000 whole life insurance policy. After receiving a financial needs analysis, it is determined that their life insurance is insufficient. The life insurance broker suggests that Jordan maintain at least $300,000 in life insurance while their children are minors. Thank you.